So we've got another awesome guest on Wise Wealth podcast. I'm really excited to get started and dig into this conversation. There's a lot of knowledge behind the markets here, so super excited to welcome Damian to the Wise Wealth podcast. For everybody that's joining us, can you give an introduction to yourself and a little bit about yourself?
Hi, Samuel. Yeah. Well, as people can probably tell from my accent, I'm from Ireland, grew up there, and left Ireland around the mid-90s to go and start my career in investments in London. Little did I know at the time, Samuel, that there was going to be the Celtic Tiger and that the Irish economy was about to boom. So just as I was leaving, things were probably getting good at home for the Irish economy. But so I left to go to London, and really just kind of with an open mind. I wasn't really sure what exactly I wanted to do, but I kind of had a rough idea that it was sort of investments. But beyond that, I wasn't sort of specific about what exactly it was. And I joined a company that was involved in researching fund managers. And I thought, well, that seems like a good place for me to learn, because I would get to go and meet fund managers all over the world and talk to them and ask them, how do you make money? What are the keys? What's the secret of your success?
Yeah.
And that was fantastic, really. I worked in lots of different areas. I worked in lots of different sort of regions of equities. I covered Japanese equities, US equities, went down to South Africa quite a lot, covering South African equities, EM, and then in sort of later in my career went into fixed income and something we call multi-asset, which is putting like everything together, and that's kind of what I do at the moment. But it was a great place for me to learn. The first part of my career, I was managing large pots of money. Yeah. These were pension funds, sovereign wealth funds that had billions to invest. And what I would do, and my colleagues, is we would travel around and try and find the best managers in a particular asset class, whether it was equities or bonds or alternatives. And then we would say to these big pots of money, this is where we think you should invest. So our real core skill is in learning about these managers and understanding them, researching them really well, understanding their portfolios. So that was a fantastic place to learn. I mean, you research and interview people all the time, so you probably don't need any help or training in it. But certainly for me at the beginning, it was quite a skill to understand, to try and get people across. Because when you have that kind of large amounts of money, everyone wants to give the best impression. Everyone's giving you the marketing, the spin, and they want to give you the full pitch. And you've got to step back from it. You've got to say, hold on a second. No. I want to really understand what's under the bonnet and how this engine works. I don't want you to give me just your pitch. And so we decided that the research analysts and people that were doing all this work, we should get proper training. And we got this company in, which were former FBI specialists. Wow. Okay. These are people who are pretty good at detecting how people might be spinning a story, how they might in some cases be lying to you, because that does happen as well, as you can imagine. Yeah. So it was great getting all that sort of experience from them and learning how to ask questions, the kind of questions to ask and the kind of reactions people have. And they showed us all kinds of videos of how they interviewed people and the kind of reactions they had. And they showed us videos of people like Shane Warne being asked questions, tricky questions. And he was an example of somebody who had a lot of tells, who showed, that he probably wasn't telling the truth.
Yeah. That's fascinating. I mean, I thought he was going to say something like Carnegie's sort of like sales team or something like that came in to show that the FBI. I mean, geez, that's going to a whole new level. So I suppose, what are you currently up to at this moment?
Well, at the moment, I work at a firm called Maseko. What we do is quite specialized, as we look after people who are multi-jurisdictional. What that means is people like Americans who are living in the UK and managing their money. They're probably people who move across regions, have probably the most complicated investment needs, because you're trying to sort out the tax issues in different jurisdictions. You're trying to sort out the investment products. So what we do is try and bring it all together in a solution. Okay. And my role really is more on the investment side. I leave the tax planning aspect to the experts, and I just focus on the investment side of things, and I build investment solutions for our clients. And as a firm, we're offering clients, we're pretty bespoke in what they need and trying to help them out. But we realized more and more clients are saying, well, I want the investments this sort of way or that sort of way. So we do quite a bit of tailoring for their particular needs. And sometimes it's because of their residency or their tax situation. So that's a lot of my day job, is looking at markets, understanding where we should position portfolios, and trying to help clients out that way, because the clients will have different levels of understanding about markets, and also they have different needs. Some people are very focused on environment and social, and we are too. We're something called a B Corp. I don't know if you've come across this before, but it's something that's kind of growing.
But yeah, I suppose just elaborate on it for anyone that doesn't know what B Corp is.
Yeah, sure. I mean, we were the first financial firm to sign up about 10 years ago to this B Corp accreditation. And it's really about balancing profit and purpose, and saying it's not all about just making money. It's also about helping out your community and the environment and things like that. So that we get audited every year by this company, and then if you pass, you get the certification where you can use their symbol. And it's about, are you doing the right things for the environment? Are you doing the right things by society? Are you transparent about what you do, and all these kind of good things? So it's been pretty good experience for us doing that. It's quite a lengthy process we have to go through every year to get approved, but I think it's getting more and more traction. You're starting to see the symbol in a lot more companies. There's probably 1,000 companies, I'd say, in the UK now. It started in the US, but it's growing. It's phenomenal. I think Generation Z are really taking to it. So.
Yeah, I've seen. I was talking to a couple of hedge fund managers in previous podcasts, and they was talking, about how, the younger generation now is not only that they don't only just want that, they're demanding that as part of their investment portfolio. So it's very interesting, because I still think there's quite a lot of like greenwashing that's going on as well within that investment world, and I think that's something that needs unraveling a lot more. Because I think people think that they're invested in sustainable products, but necessarily they might not be. But I suppose from like a consumer level, there definitely is that demand of, I'm willing to pay more if this is a fair trade, or I'm willing to pay more if this is going to be, less of a carbon footprint sort of thing. I think it's very exciting.
It is very exciting, and it's definitely changing our industry. It really is. And I mean, the UK regulator is going to come out with some changes in the next few weeks or months, and we will see what that means, because they're really trying to stop this greenwashing effect that you're talking about. Yeah. But I think it is exciting. I mean, my kids are asking me about all these questions, and I think it's great that that generation are asking these questions and wanting change.
Yeah, I'm hoping that, for me, I'm a strong believer in that change will move on. Like I said before, I currently live in Isle of Man, and here we're one of the only biospheres in the world. So it's like such a big thing for me to hopefully see that generation change, especially in the UK. It'd be awesome to see that. And also, it's interesting what you're doing working with the overseas investors, because I've seen that quite a bit with, let's take, for example, South African individual moving to the UK and trying to get the lending side of things for like mortgages, things like that, also difficult from that perspective. So I can completely see the business model that you're working on. I think that's really interesting. And from a market perspective, what are you sort of telling your customers to sort of expect, I suppose, from 2024?
Yeah, it's been fascinating. I mean, that's part of my sort of passion for the industry, really, is that everything is different, you know, and whatever I sort of predict is going to happen next year probably won't, you know, because you're always going to get surprised, you know, and you know, some people will always say to you, well, you know, you're in the industry, you should know these things. And what our investment approach is, it's pretty humble. You know, I've been through lots of cycles, and I've seen how things always change and how difficult it is. I mean, if I went back to you, Samuel, in 2019, and I said to you, look, I'm going to invest your money, but I'm going to tell you what's going to happen in the future, that there's going to be a pandemic and everyone's going to have to stay at home.
So on that one, I was really lucky, you know, from an investment perspective on that side. I actually knew about that crisis unfolding before it was even sort of mainstream media, which is, I think it was a blessing in disguise. But actually, it sounds so crazy, but one of my customers actually lives in Wuhan, and so I literally had messages like, "You're not going to believe how crazy this is. What's happening over here?" And I was like, I could not believe it, and then he was sending me, you know, footage of like people throwing their cats and dogs from story roofs and stuff like this, and the hospitals were all crazy. And I was like, no one's even talking about this over here at all. And so we did a huge like research piece on it to work out like, you know, where would be the most demographically sort of affected areas. And initially, one was Italy and the other one was Japan, just based on age demographics. And we wasn't far wrong. Japan, it didn't go too crazy, but Italy was, you know, it was one of the worst places that where it got hit. But yeah, it was lucky.
It's fascinating because our senior analyst, she's from Wuhan.
Whoa. Okay.
Yeah. So we were the same. You know, we're, you know, thinking about those things early on. But I mean, I think, you know, if you had known back then there was going to be a pandemic, and if you knew there was going to be inflation like the 70s, and that there was going to be a war, you know, over the next 3 years, if you knew all these things were going to happen, you'd probably say, Damian, you know what? I'm not going to invest at all. I'm putting my money under the bed and I'm just going to wait till that's all over. And the market's up 30%. Since then, you know, and I think that there's a lesson in that for us, in that, you know, even if you knew the future, it probably wouldn't help you with investment decisions. So you've got to think longer term. And right now, you know, we're still dealing with the aftermath of COVID and inflation. So we very much had the view that inflation was going to be part of COVID, and we took a lot of inflation protection in our portfolios. So then we started in the summer of last year, we started having the conversation on our investment committee saying, you know what, we've played this part well. We've protected portfolios as inflation went up, and we've reduced our bond exposure, which really helped out. And we've lightened we're focused on valuation on the equity side. And we came through that pretty well, but we realized you can never stay completely steady. We want to think of the long term. We don't want to be churning our portfolios. We want to be quite strategic in what we do. But these are, you know, the environment was changing pretty dramatically for fixed income. So what we've been doing is this year is looking at ways to increase exposure, because we do think that maybe it's not next year, maybe it's the year after, but interest rates ultimately come down. How do our clients profit from that in the most efficient way? So we've been looking at doing that, building that into our portfolios in more recent times. Those are the kind of discussions. On the equity side, it's been fascinating. I mean, you probably know that there's 7 companies, they call them the Magnificent Seven, have been just dominating the market. I mean, it is the story this year. There's nothing else. The US market is flat if you exclude those companies. It's amazing.
I was at a Ned Bank sort of investments reported evening, and it was really fascinating that they was talking about the same sort of scenario, how, you know, these 7 companies that have all mentioned the word AI, and, you know, the market has ultimately been dominating off the back of that. But yeah, just their insight was very interesting of where they see value going into 2024. and there was talking quite big about the UK markets, about how there are some great companies from a value perspective with low P ratio, good and ripe and ready for 2024. And I found that very interesting because I think that when you do look at that and you start peeling the layers back, the UK economy is so disconnected to the UK markets. And I think that's more from like an exposure point of view of where the UK stocks actually have their revenue and earnings actually getting generated from. It's probably, it's really global in that perspective. And I think there's some fascinating equity opportunities within the UK specifically going into 2024.
Are you using AI in your business? Because I mean, I'm surprised as the focus of the market is just on these 7 companies. I think the benefits of AI are going to be, pervasive. And I think there's going to be a lot of companies benefiting. And I think next year, in answer to your question, you're going to see that effect. You're going to see who are the actual winners, who's using this to make their business better.
Yeah, I mean, I literally got off a podcast just before this one, talking to a guy called Duncan Krieger, who runs commercial bridging and lending, and how they're implementing AI into the whole commercial aspect, taking the whole sort of report and summary of the potential property and summarize all of the points of the good and negatives from this from an investment perspective, and then really shortening the amount of time that they need to put into it. And I think this is how you're going to see this side develop, especially within those markets. I'm a shareholder of a company called Future PLC. I've been buying it as it's been falling. It went down to like 700, and it's now back already at like I think 980 already at this moment in time. And I think net I'm up about 30% on position, but I'm waiting for that to actually get well above 2,000, and I think it will do that because Future PLC is they buy magazines. I'm not sure if you know them too well, but I think they were FTSE 100. They might have dropped out of it when they had the sell-off, but they own like your hobbies and crafts magazines. They'll own your shooting magazines. They'll own your tech magazines. I mean, every single magazine. I think it's like 1 in 3 consumers within the UK and the US is reading a Future PLC documentation. And I was like, it's only going to take just for them to mention that we've now implemented AI into our publications and we're now able to do X or reduce our costings for the stock to absolutely explode. I mean, take that away anyway. It's a good investment from a fair value perspective, being undervalued, low P ratio in comparison to the market, great earnings, all the rest of it. But I sit there, I think it's only going to take for them to go, how do we jump on this bandwagon of implementing AI? And the stock will be back at its highs. I mean, surely this is what these businesses should be reviewing going into 2024. That what can we learn from 2023? Where were the investments and it was into this space? Should we be allocating some of our budget to go, how do we actually implement AI into our business? Because ultimately, it's such a buzzword at this moment.
Absolutely, yeah. I think we're this is phase 1, and it's that sort of, it is people getting excited just about the name and the concept. But the sort of phase 2 is who's actually delivering, who are the, which companies are actually, and, we, in our portfolios, we have a bit of a small cap tilt. So we have small companies because we think they're going to benefit. Like the company you said, those are the ones that can really benefit because it's costly for them to add people. If they don't have to add people, if they can employ AI, it's going to make them much more efficient. So I think that's going to be an interesting area over the next, maybe not next year, but over the next couple of years, I think, and we're really happy about that position in our portfolio. We also have quite a tilt in our portfolios to valuation. So we're looking for companies that aren't too expensive, but also are profitable. So we're trying to sort of stay away from the value traps, but also the growth traps, because there are companies that are, people's expectations are going to get wild, like they did. In the tech bubble, there was some crazy stuff happened, and I expect that will happen as well. So you need to have an investment discipline so that you don't get caught up in the euphoria. We kind of went through this recently with the stay-at-home trades. Where everyone got all excited And that was actually something that worked out okay for us, because we didn't buy into those kind of into the euphoria. Our valuation discipline kept us sort of on solid ground, and then the market eventually capitulated, which meant we didn't go down as much as the market, which was quite nice. So we build our portfolio on those kind of pillars. There's the valuation, profitability, and small, and we think that we're really well placed to benefit as the benefits of AI roll out across the industry and across the economy.
Do you think going into 2024 that you'll have exposure to that magnificent sort of 7 stocks in the market, or do you think that it's time to sort of like lay off of that, reduce that, move it elsewhere?
Yeah, we do have exposure to that segment of the marketplace, but it's not something we're emphasizing. We have an underweight position relative to the market, so we are cautious. We think the valuations there are probably getting, if you look at history, they're getting quite frothy now. So I think a lot of the expectations being built into the price, it'll be hard for them to exceed the expectations that are already in the price at the moment. So I would be cautious on that sector of the market, just because I think also that, like the companies you mentioned, that there's excitement elsewhere. It's not all about the big companies, and it's hard for big companies to really grow. Just the maths of it. When you're that big, it's just gets harder.
Even looking at it from a perspective, we did some research around sort of the valuations of US small caps, and even if you look from an ETF perspective, they're at some of their lowest valuations that they have been. And I sit there and I think, this could be a very interesting time now to be investing into small cap ETFs going into next year. And we look at Wells Fargo data, JP Morgan, and they're all saying the same thing around the small caps. The valuation is one of the lowest it's been. And we can see potential growth here coming back into the small cap markets. I think it's a very, I think there's a lot of sort of like got breadcrumbs from these sort of institutional funds that they leave. That, when you start peeling it back, you can kind of go, I see what you was looking at there.
Yeah.
And I
think a lot of the small caps too, they really got beaten up because people thought higher interest rates that they wouldn't cope very well. They've done okay, and I think what we'll find is actually as rates start to moderate over the next 18 months or so, that they may well be the beneficiaries, and they may well drive performance of the marketplace. So yeah, we would agree with you there. We think that's something we're positioning for. And we would not be surprised to see. I think if you look at the performance of the Nasdaq relative to small cap, it's at an all-time extreme. We've never seen an environment. So this to me screams opportunity. Now I don't know if it's going to work out next week, next month, but you really have to be there, positioned for it to benefit. And we're taking a longer-term view that over the coming years, if you look back over the history of the markets, small cap have outperformed large cap big time. So we're really thinking that will right itself.
100%. I'm in agreement with you. It's actually quite nice to hear from your perspective as well. That shows that the research that we were doing around it shows that, because when we do the comparisons between that and the main markets such as the S&P and things like that, and you look at sort of the deviation in gains between the two of them, how they're doing, they are at extreme levels. And again, it does sort of scream opportunity. And I was looking at JP Morgan, and it'd be interesting to know if you think that we are at peak interest rates and you think that they're going to come down from here, or if you think they're to go higher. But just to give you a bit of information behind that, JP Morgan says that historically speaking, the following 6 months after peak interest rates is always seen an equity rally. And arguably, look what's happened. I think that people are starting to think that we may be at peak rates already, and we are seeing an equity rally, which is almost quite disconnected to the current economy of what's going on.
Yeah, absolutely. We took that position. Really, we started adding a bit more interest rate sensitivity to our portfolios, because that that relationship where longer dated bonds do better if interest rates fall. So we've been adding more of that to our portfolios to benefit from when interest rates fall. I wouldn't be surprised that we start to see a cut next year. If it's not in 24, it'll be in 25. But I think we thought inflation was coming down, and it has come down. Now it may start to slow, and it may not go all the way back to target, but inflation is definitely coming down. Bond yields will probably fluctuate a bit. I don't think it's a straightforward. I mean, we've already seen some of the market pricing in that expectation that the Fed is done and that the next move is to cut rates. So we've seen bond yields come back pretty significantly in the last few weeks. So some of that trade's already started to happen. So we might start to see, a bit of movement over the coming months where maybe that goes back a bit. But I do think that you've got to be thinking longer term. I mean, do you remember pre-COVID, everyone was saying rates are going to be low for forever because there's things like there's too much debt in the world. There's the demographics, technology was making us all more productive. That there was never going to be inflation ever. And then, COVID happened, and then we got inflation. I wouldn't be surprised if we go back to that world, right? Because the amount of debt in the world is bigger.
Yeah.
Technology has just got a boost because of AI. So that's going to make us more productive in theory. And the demographics haven't changed, So I wouldn't be surprised to see us going back to that pre-COVID
Really? That's interesting. It'd be interesting to see if we can go back to that level. I don't know. I have a feeling
it will go. I don't think it goes all the way down to we got back to we got to zero, I guess, but I don't think it goes quite that far. But I wouldn't be surprised that we're talking about things like deflation in maybe 2 or 3 years' time or earlier.
Yeah, and that's now a conversation that we are having a lot more of, and I think it's becoming a lot more voice now. Is that are we going to see the deflation? And I think that's again another aspect. I think realistically, of interest rates over the next 1 to 2 years, I think we'll probably be down in that 3 to 4% range. I think, but I don't know if we're going to go. I don't know if we're going to go much lower than that from an interest rate perspective.
I don't know if most people get it. I think a lot of people are putting their money into money market funds because they're saying, well, I can get 4% or 5% now in cash with no risk, which is fine if you need to buy a house or you need to buy a car. But, I hope that people aren't abandoning their investment plan because there's an opportunity outside of money markets in bonds. And equities, if you exclude those magnificent seven, they're actually, they're not that bad value. And as you said, there's some areas of the market that are absolutely amazing value. It's like Black Friday, it's discounts. Everyone loves the discounts when it's consumer products, but when it's the market, people are always afraid to buy, bizarrely.
Yeah, I've always found that such a strange thing. Like I think one of the best stocks that are performing in my portfolio at the moment is Shopify, and that's just absolutely rocketed after Black Friday sales. But if you look at where it was during the highs during COVID and so on and so forth, and then we've had that sell-off, you look at it from a valuation perspective, and it's like trading below pre-COVID levels, and you think the business has got more customers now than what it did before that situation. So why is the valuation down here? So I was like, this is such a good buy. I think Meta was another great buy for me after they went for a bad spell as well. Same with Netflix. They did really well. I think there's been some absolute great opportunities over the last few years, but you just have to be very picky with where you're putting it and where the opportunities are. I think another one of the good ones I just exited last week was DraftKings. I bought in them at around 15 and sold at 39, and they were fantastic. And that was a very simple idea that the US, more states will open up more rights to gambling, and DraftKings will capitalize on that. It's not really rocket science to do that, but it brings in more customers.
It's not rocket science, but it is difficult for people to buy when things are falling. And I think that's the tough thing is trying to be contrarian. Now you realize that in your approach, and you're looking for value, and when things pull back, you take advantage of that. But I think a lot of people, that's not a natural instinct for people. A lot of people buy high. You've probably heard that famous story that Fidelity have of who are they tried to figure out which were their best and most successful clients.
Right.
And
I haven't heard it, no.
They went through all the different types of clients they had, and the ones that had the best performance were the dead ones, or those accounts that were inactive.
Wow, because they just left it.
They just left it. Yeah.
That
And
is crazy. The best investor is a dead investor. That's a scary stat for you, isn't it? Because they didn't touch it and they just let it do what it's gonna do.
There's another one. Peter Lynch, he used to manage a big fund, one of the biggest funds in America, for many years. And he looked at when all the flows came into his fund and when they went out. And all the money came in after he had a good period of performance, and it all went out just at the worst possible time. Yeah. And on average, he worked out, even though he was like the best, he had the most amazing 10-year track record. He just killed, everyone. He was on billboards all over the States in the 80s. He was a celebrity, and he worked out that his average investor didn't make much money because they got in at the wrong time and they got out at the wrong time.
It's having that sort of emotional intelligence of just reiterating to investors, again, just talking about Ned Bank when they was talking, it was like their investors can shave off 2 to 3% in performance per annum just from making emotional decisions on exiting and entering at the wrong time. I don't really understand the mindset of it, if I'm honest with you. I wouldn't say I was the most savviest of people, but when Black Friday comes, everyone goes crazy because they get a discount. So why not go crazy when the stock market goes into a crash? If you're seeing a 30% drop in the FTSE or in the S&P or the Nasdaq, and you look at it from a perspective of the company's still performing, it's outside environments that are affecting this fear.
Yeah,
it's not going to affect the bottom line in the long term. I just don't understand that mindset. For me, I just sit and I'm like, wow, we've now got 30 to 40% pullback. This is amazing. A lot of people are raving about buying into Tesla and stuff like that, but physically, I just can't do it because when I look at the PE ratio, and I look at it from a valuation perspective, I'm just like, I get that you're exciting, I understand that, but I just can't do it. I like looking at things and going, this stock is currently undervalued, and I like buying things at discount. That's just how I am. I don't think I like looking at it going, this is trading above its valuation. It's not something that I want to sort of be buying. I'd rather buy something bad, allow it a 1 year to 2 year window to sort of pan out, and then you get these huge moves. Shopify was a great one that I had from after COVID, really, from when we had the whole market sort of pull back after that period. And I think one of the best ones that I bought, and it's not even up that much. I think I'm only up like 30% in it at the moment, is IAG, the airlines. I was like, well, I can't see them going anywhere. I get that this is going to be a bad period of time for them. And now we're starting to see us come out of that stage. We can start seeing airlines start performing better, especially over the next year or two. And I think,
oil prices are lower as well. That might help airlines. People are starting to travel, and people want, and we're talking about sort of younger generations, and they want to travel, and they're going to travel. So I wouldn't be surprised to see airlines or travel companies doing well. But I mean, with our approach at Mosaico, we're very much sort of trying to find where there is opportunities, and often that means having to have a discipline to go against the grain.
Yeah.
So right now we're not buying into the Magnificent Seven, but we do like the smaller cap areas. It's out of favor, but that's the opportunity. I don't know when it's going to come, when we're going to get rewarded for that, but it's the right thing to do. You have to look at history of markets to take some sort of to get some guidance, if you like, on portfolio positions.
I suppose from your perspective, are you doing that from an individual stock level in the small cap, or are you doing that from an ETF and a basket sort of approach?
Yeah, we're doing it through ETFs. We use active ETFs. So these are maybe more quantitative approaches to investing. So it's like we will invest in our quantitative small cap exposure. It'll be very diversified. It'll be across hundreds of companies. We know small cap should do well. We don't know exactly which companies are going to benefit. So we're not trying to be heroes and say we're going to pick the exact companies that are going to do well, because that can be tricky. I mean, you saw what happened with meme stocks, you know, and you know, we want to stay away from those because we're thinking longer term. We're conservative in our approach, and meme stocks were something that just went up because people got together on Reddit and just said, "Let's do this," you know, and that was just an extraordinary thing. They went up a lot, but they came down a lot as well.
They did come out. Be interesting to see. That's the new thing, wasn't it? It was only a couple of days ago. I think Reddit are looking to file for IPO early next year. Be interesting to see if they turn into a meme stock themselves.
That's interesting. Yeah,
I'm sure they'll get quite a fair bit of backing from the community. So it'll be an interesting perspective. Do you have any exposure to, say, like private companies, like from a mergers acquisitions perspective, where you buy into private companies?
Yeah, we're looking at that more and more. Not so much private equity initially, so we're thinking more private credit is an interesting area. We like private credit. We think it's still virtually a new area.
Yeah.
It's really only been around probably 6 or 7 years, which is pretty new in investment. So yeah, that's an evolving area. So we're increasingly looking at that. Private equity as well. We're looking into it, but I think you need to be maybe a bit more niche there. Going back to what we were talking about, impact investing. Have you come across that before?
I think it's worthwhile for everyone listening to explain it, just if they're not aware.
Sure. Yeah. So impact is an area of private equity where it's about saying to people, well, if you really want to make a difference, if you want to get involved and invest in companies that are changing the world, they're trying to make the environment better, they're trying to make society better, here's an opportunity to invest in them from a private perspective. So that means locking up your money for 10 years. But that's what's required for these companies because they are small companies. They're trying to become larger. But they're at a phase in their development where they really need money to be invested. That's permanent capital. They can't have money coming in and out because they're so small. But it's a very exciting area because these companies are trying to do great things. They're trying to do things that are really going to change our world, make the environment a better place, and trying to improve lots of aspects of society. So it's quite exciting.
Coming out on it. Yeah, impact investing. We've got a podcast coming out on it, I think, in the next couple of weeks. I was talking to a fund manager that's they've got a fund that's about 30 million euros, and they're focusing on startup impact companies, from like water sanitation, but with a lower footprint, and then also down to even like fashion and clothing dyes and things like that, better for the environment. And it's quite interesting to see how they're becoming an interesting space for investing. I find it fascinating, but again, it's following the trends of the younger generations. What do they want out of this, and how can they be involved in that? And yeah, I think there's a definite growth there. It's just getting that, the 1 in 10 right, isn't it, on the startup side? And getting involved in that. Do you have any exposure to currencies or anything like that?
We don't really. I mean, our clients have to be careful about currency exposure because if you're a US investor and you're living in the UK, any gains on currency are also potentially you have to pay taxes on. So we'd rather focus our energy on the investment side of things rather than on currency.
Sure. Do you do any research on the currency side of things, for example, like the pound against the dollar and where you see that potentially going in 2024?
I mean, in my role, I mean, I've got to be looking at what's happening in currency markets, looking at what's happening in interest rate differentials. I mean, we've been through a very strong environment for the US dollar. it wouldn't be surprising if we talked earlier about bond yields coming down, and that would be a reason. If they come down first in the US, that would be a reason why we shouldn't be surprised to see the US dollar get weaker. We've seen a bit of that recently, and that would be good for a lot of asset prices and good for markets probably more generally if that were to happen. So that would be something I'd be sort of watchful for. Is probably is US dollar weakness, which would be good for EM currencies probably.
Yeah, for sure. For anybody listening and going to be watching, where can they find out more about you and your company?
Well, we have a website, and we're starting to do podcasts. We've taken a leaf out of Samuel Leach's book, and we're trying to do more of that ourselves. But our website would be a great place to start. At Maseco, MASECO. It's a bit of an unusual name, but Maseco Private Wealth is the website to go to, and there are contact details there, and there's loads of people who'd be happy to answer any questions people have.
I look forward to my podcast invite. I'll have to come on your podcast. And,
it's a deal.
Well, it's been fascinating. Honestly, I think everyone listening is going to absolutely love the outlook of what you're looking for in 2024 and what you've been up to. I think it's fantastic. So thank you so much for joining me on the podcast.
Thanks for your time. Thanks for the invite. All the best.